What is going on, traders? We need to talk about the absolute blunder that the Fed made last week. We got a chance to cover it live on the channel, but I didn't get a chance to do a follow-up and tell you how the market reacted and how a lot of economists and prominent financial personalities are now very critical of the Fed. So in case you missed it, what happened was the Fed did another 75 basis point rate hike. This is the biggest back-to-back rate hike since the early 1980s. So right off the bat, you might be thinking to yourself, hey, well, the Fed is doing its job finally and remaining hawkish here with another 75 basis point rate hike. Yes and no. What Jerome Powell actually said was either a blunder or an intentional political move. Let me explain. First of all, Jerome Powell denied that there was a recession, really the same line that the White House has been towing. To me, this was a clear political move, as every president on either side doesn't want a recession on their hands, and they're going to try to influence the Fed to have the same messaging as the White House. This goes for both Democrats and Republicans. This is not a partisan take, so don't get your panties in a bunch. However, not admitting that we are in a recession is not the worst thing that Jerome Powell actually said. Here's the exact quote 15 minutes into the press conference when the market started rallying and really hasn't stopped since as of the time of this recording. And we are now back above 4,100 on the S&P 500. He said, "We are now at levels broadly in line with our estimates of neutral interest rates, and after front-loading our hiking cycle until now, we will be much more data dependent going forward." Now, what does neutral mean? Neutral is the rate at which the economy delivers its potential GDP growth rate without overheating or excessively cooling down, meaning there isn't any monetary policy required, either aggressive or accommodative, and the economy can just keep going as is. The problem with this is we are nowhere near finished with the inflation picture. As a matter of fact, just last month, CPI came in higher than the month before, when it wasn't even expected that we would go over 9% year over year, and we hit 9.1% year over year without really any sign that the CPI is slowing down. Now, if you're only tracking the price of commodities, sure, you could say that the cost of producing stuff is going down, but that does not really matter when Americans at the pump and at the registers are still paying inflated prices for food and every single item, really. But anyway, how irresponsible was it for the Fed to say that we're neutral? Because there is no sign and really no marker showing us that we are near neutral, or how the hell the Fed even achieved this. So what exactly does this mean, and why did the market start rallying? The market rallying that day doesn't mean much. As a matter of fact, every single FOMC meeting in 2022, the market rallied after Jerome Powell was finished. And if you look at this graph, it shows these data points, which is why we actually bought call options on the indices right when Jerome Powell was delivering his speech. Those calls ended up going 276% that same day. If you want access to all of our data-driven trades, our analysis, you want access to the courses, the Zoom calls, everything that the Academy entails, link is in the description below. Click on that link and apply with one of our ambassadors today. So besides that one-day rally during the FOMC meeting, where we always get a rally after the information is priced in, why is the market continuing to rally? And it looks like the market has an appetite for being risk on, at least in the short term. Well, if the Fed says that we are neutral, this means that they are already telegraphing that they will likely be easier or more accommodative in September and in the following FOMC meetings. Meaning, if we're already at neutral, hey, mission accomplished, there may be no need to go heavier in future FOMC meetings. And as a matter of fact, we could likely even pivot if the economic situation worsens. And you can even see the bond market pricing this in at the moment. See, if bond investors aren't expecting real yields to go up, meaning if the Fed is going to be rather accommodative and could even pivot and yields could come down, then bond investors are going to pour into bonds now to try to take advantage of the highest rates that they think they will get in the short term. As a result, real yields hit their lowest level in 2 months, because as bond investors pour into bonds, yields go down as bond investors keep buying them up. When bond investors don't buy yields, they keep going up in order to look attractive for bond investors to jump in. Now, what happens when yields and real yields decline? Well, bonds become less and less attractive as yields are falling, which means the market is going to go risk on once again and dive into equities. This is why the March 2020 pandemic, this is why stocks went up so fast, is because yields went all the way to zero, meaning you were not going to get any return for your money if you invested in bonds, because the Fed was trying to promote spending in the economy. So folks jumped into riskier assets, and they started buying up things such as cars, luxury watches, etc. as well. Now, the problem with this is that the Fed is supposed to be fighting inflation. However, being in a risk-on environment where investors are pouring into equities, this signals a risk-on environment and furthers inflation as money keeps pouring into the economy, thinking that the Fed's job is done and we're at neutral once again. This drew a lot of criticism and skepticism from a lot of high-profile financial figures such as Bill Ackman. Bill said the problem is that we are not close to a neutral rate. While 2.25 may be a neutral rate, with 2% inflation, it is extremely accommodative rate with inflation at 9%. One's cost of borrowing is a function of the interest rate and the rate of inflation during the term of the loan. But even at today's credit spreads, the real cost of money is still extremely cheap, so everyone is incentivized to borrow and spend, fueling inflation. That is why in previous highly inflationary economies, the Fed had to raise rates above prevailing levels of inflation to kill it. While I do think inflation will begin to come down soon, I don't think there's any prospect of getting back to 2% without materially higher rates, 4% or more, which are maintained at these levels for extended periods. And if you look at the history of interest rate hikes, he's right. We've never had a period of high inflation, near double-digit inflation like this, where small 75 basis point rate hike, and I'm using small here relatively, they're big in context. However, they are small if you are trying to fight double-digit inflation historically. He then goes on to say Powell's views on the neutral rate have only served to materially ease financial conditions, making the inflation problem worse and his job more difficult. This is true. What happens on August 10th when CPI comes in? If CPI comes in and it's even hotter than expected, well, then obviously we are nowhere near neutral. Or if it's even anywhere near the 9.1% year over year that we saw during the last CPI. So because the Fed will likely have to keep raising rates, and there's no way that they can be accommodative here unless they are really trying to ruin Americans' lives further by increasing prices once again, the Fed has to act very aggressively, which is leading a lot of experts in the field to believe that the worst is not over yet and we are due for another leg down. Now, if you've been following this channel, you know that I've been tracking this fractal on the S&P 500, same as the last earnings season back in March when the S&P looked like it was going to hit a Adam and Eve pattern and break out. It finally reached for another leg down. Now, I said that if Apple, Amazon, Microsoft, Google earnings were good, Tesla as well, then we could hit that 4150 on the S&P 500. And where we go from here will be determined by the FOMC rate hikes, by the CPI, by the GDP numbers. Are we in a recession or not? And if I'm being completely honest, I just don't see that if the Fed has to keep raising rates, how we can continue upwards here, unless, of course, the August 10th CPI numbers come in even slightly lower than expected, and then the Fed decides, hey, job done, we don't need to hike aggressively in September, and they actually ease up. If they ease up in September, yes, I think the markets can even get back to all-time highs before end of year. That is the power that the Fed has over the money supply, is that when they really want the economy to act in a risk-on manner and continue spending and dumping money into equities, they can actually do so, which is part of the reason that the COVID 2020 crash was so short and why the rally was so violent, because it was some of the most accommodative, actually the most accommodative policy we've ever had in this country, even more than the 2008 financial crisis, because the Fed, remember, also has over $9 trillion worth of assets on the balance sheet. It's not just the interest rates. Now, in my view, as I've been saying time and time again, I don't really worry when the bottom is, especially during a recession. Every single recession to me is an investable event. So now that we are in a technical recession, whether the White House wants to admit it or not, this to me is a period where I will start nibbling on stocks that are 25, 30% down. And I mean only blue chip stocks here that you don't normally get the chance to buy at these discounts. So Google, Tesla, Amazon, Microsoft, Apple, these were all down 30% or more. The triple Qs, which is the ETF that tracks the NASDAQ, was also down 30%. The S&P 500 was down 20%. There is no need to go crazy here on high beta stocks. So yes, a recession to me is always an investable event for the long term. And obviously we will continue to trade on a day-to-day basis. If you want to track what I'm investing in, if you want to track our trades, my analysis, if you want access to the chats, you want to talk to thousands of traders who are trading all day, every day, you want access to the courses, the Zoom calls. We're about to do a Zoom call tomorrow as of the time of this recording, where we go over technical analysis, day trades, options trading, etc. Link is in the description below. It's a great value, so sign up. It's a great resource as well if you're trying to further your trading and investing education. Anyway, traders, that is the breakdown of why the market is rallying heavy here, because the Fed really is signaling that somehow we have gotten to neutral rates. Don't even know how they're calculating this at this point. But we will see what happens on August 10th, and we will see what happens during the next FOMC meeting in September, whether they take their foot off the gas or not. If they do, honestly, believe me, that all-time highs are very possible if the Fed takes their foot off the gas. If they don't, and they actually are serious about fighting inflation, then I do think that we are due for another leg down. It might not be as violent as what we've already seen, 30% down. I don't think we'll be down another 30%, but we will likely see an incremental drop if the Fed keeps on raising rates to try to fight inflation. Leave a comment down below. Let me know what you think about the Fed's meeting last week. Let me know if you're starting to invest. I would love to hear from you. I try to answer each and every comment. Hit that thumbs up if you got anything out of this video. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.